Welcome back to TyNance, another week in the stock market. This week, markets kept on rallying, and as a result, my portfolio value or account value is now up to over $110,000. If we take a look at the results of my portfolio since year to date compared to the S&P 500, we find that my portfolio over a time frame of from year to date up till now is up 14.43%, while the S&P 500 in the same time frame is up 8.58%. So I am almost outdoing the S&P twice in performance this year up till now. I was losing compared to the S&P 500 in the period of the tariff crash, but I came back strong when the market started rallying again, and so I'm almost up twice the results of the S&P 500 this year or year to date, which is really nice to see. And I do expect my portfolio to keep outperforming the S&P as long as markets continue their rally up. I must say that since my portfolio is converted to euros and I have a lot of my portfolio value in dollars, this is a huge headwind for me this year as the dollar weakens, the value in euros becomes less. So this has a negative impact on my returns, and that makes it even more nice to see that I'm still outperforming the S&P by a wide margin. Now let's get into some of the highlights of the earnings reports. I had four companies posting earnings this week. The first one is ENPH. ENPH reported beats on top and bottom line, but their guidance was quite soft, lower than expected by analysts on the midpoint, and so the stock dropped again. This was already my worst position, and now it dropped even lower. Am I planning to buy more ENVs because of it? I think that is a hard decision to make. I do still feel that in the long term, the solar industry has a lot of potential, but in the short term, it is facing a lot of headwinds, especially now in the US. And since this is a US-based company, that is quite important. So, for example, the political landscape is not in favor of renewable energy sources like solar currently. This is since Trump became president. Trump is rooting for fossil fuel and reserves and not for renewable energy. So some tax credits will be going away, and this will have some impact on Enphase margins and probably also on the revenue. On the other side, I think Enphase in the solar industry, like I said, still has a lot of potential as the sector itself evolves, and we need renewable energy instead of fossil fuels. So for now, I am just holding on to my 40 shares, and even though I see a lot of potential in the long run, I don't think this is gonna turn around soon. So it feels a little bit silly to throw some more money at the stock now, while I could also buy stocks currently that I expect do um, give me some good returns in the near future. So that's why I'm investing into other companies now, but I do still hold on to my end phase shares for now. Next, we have Alphabet, the parent company for example, Google and YouTube, of course. A lot of analysts and people in the financial sector expected Alphabet to post um, bad earnings in terms of their search volumes, so the Google search um, engine. But Alphabet each quarter shows that Google search is still growing, even though there is a lot of competition from other LLMs, like especially ChatGPT, for example. But Alphabet does not seem to slow down in search. They are growing rapidly in their cloud business, and also YouTube and other services are growing really fast. So as a lot of people think Alphabet is a loser of I feel they are a beneficiary of AI. And the competition, like ChatGPT, I believe this will only give Alphabet more reasons to innovate sooner than they would have done if the competition was not here. And they just keep showing good results even in search. So I bought a lot of shares. I increased my position to 50 shares in the tariff dip, and I'm definitely planning to hold on to my Alphabet shares as I feel they are undervalued compared to other big tech companies now. And I believe that if they can just keep showing it in the numbers, that eventually they will get up to a higher multiple, and that would bring me a very good return compared to the general market. And I do not see a lot of risk in the company with the current valuation as well. So it's just a really nice risk reward to me. Then we have Tesla. Tesla came out with numbers not worse than expected, but the company's fundamentals are really slowing down, especially the car sales, but now also the energy business is declining. So they were only showing growth in services, which is not enough. The stock dropped in first instance, but because there is a lot of hope under shareholders of Tesla that autonomy and robotics will become a big part of the revenue of Tesla in the near future. And that dream and hope is still very much alive, which is visible in the stock price, because the stock price has already recovered most of the loss after the earnings report. So currently I am holding on to the 8 shares of Tesla I have. It's not a large position for me, and it went up very fast after I started my position. So for now, I feel with the current fundamentals, it's really overvalued, but I do still see some potential. But they have a lot to prove before the stock price will significantly increase. So if I would have to use my cash for something, I would not buy more Tesla currently. Then last one we have LVMH, Louis Vuitton Moet Tennessee, the luxury brand designer, was coming in with a revenue and net income decline compared to last year, but the CEO on the call said they still have a lot of conviction in growing the overall brands and market share in this year. So the luxury sector is facing some headwinds. Tariffs is one of them, of course, and additionally, inflation was of course really high, which led to them raising prices a lot. But currently, in the current economic environment, it's hard to get the prices up for those luxury items, it seems. But I still believe this is a high quality company, and I feel that at some point fundamentals will turn around again, and the company will get back to growth. So until that time, I think it's a really fair price currently, and I definitely like to buy some more shares for the current valuation of LVMH. That's it for this week of earnings for my portfolio. Next week we have a lot of different companies in my portfolio coming out with earnings, such as SoFi Technologies, PayPal, and United Health. So next week I will definitely update you on those companies and what my moves are from the earnings reports. Now let's get into the trades I made this week. First off, I bought United Health. I doubled my position, going from 5 shares to 10 shares for an average price of $285.40. I doubled my position because this company is reporting earnings next Tuesday. When this video comes out, that should be tomorrow. And the CEO or the company planned 45 minutes extra for the conference call. I believe they will use this extra time to get out all the questions and some of the negative sentiment that is hanging onto this stock out of the window. So if they can get back some of the faith in the company, then I believe the share price could jump starting from Tuesday, because all the negative events are already priced into this stock, and I already stated before, I felt the stock price reaction was pretty much overblown. That's why I initiated a position, and that's why I also doubled my position now, because I feel like everything is priced in already, and fundamentally the company and the insurance sector as a whole should turn around soon. And if they will, then share price of United Health, but also other companies in the insurance sector will follow. And that's why I want to have a good allocation to the insurance sector. And I see this as a great risk to reward. So that's why I increased my position to 10 shares. If it does drop on the earnings report from Tuesday, and I see no difference in my thesis I have for the company and the sector as a whole, then I will definitely add more shares in the coming months, as I truly like this valuation for such an amazing company, as this company is I believe the third in amounts of revenue. United Healthcare is bringing in more than, or at least from last year, over $400 billion in revenue a year. So this is definitely not a small player, and a serious company with a silly stock price currently. Then I bought another insurance company in Oscar Health. I already held 100 shares, so I also doubled this position from 100 shares going to 200 shares. I bought the new 100 shares for a price of $13.78. For Oscar Health, I have the same thesis as with United Health. I feel that the sector as a whole is punished too harshly, and I believe that the sector will soon start to recover. And if it does, I can make a great return with companies like United Health and Oscar Health. Why do I own two insurance companies, you might ask? Well, United Health is the main player. It's far away the largest player in the US, and Oscar Health is a way smaller company, but with a lot of potential and a lot of growth. So I started a pair investment, two companies in the same sector, um, just so I can mitigate some risks if, let's say, United Health does underperform. Then I still have Oscar Health, and also the other way around, of course. So it's like hedging between two positions in the same sector. But I of course am rooting for both positions to do well in the near future. So I doubled my position in Oscar Health in a share count. I also own five, or I also sold five puts on Oscar Health. So I have a lot of conviction in the insurance sector with the current valuation, and that's what I am showing. So that's why I'm increasing my positions and overall value in the insurance sector. So now let's wait until United Health reports their earnings on Tuesday to see what will happen in the sector next. Oscar Health actually came out with some preliminary results for next quarter, or actually for the rest of 2025. They changed their guidance. They expect to receive or to make more in revenues than they previously guided for, but on the same time they also expect a small or narrow loss instead of a profit this year. So the revenue going up through guidance is really good and really nice to see. But it's not nice to see that they will go from a profit to a expected narrow loss this year. But that is because mainly caused by the medical loss ratio being higher than companies expected. This is not just for Oscar Health, but this counts for the sector in general. The insurance sector and the companies in it do expect this the medical loss ratio to normalize in going forward from 2026. So if it does, then the company will only make more profits from then, and until then they will of course increase premiums. So revenues will keep on rising. So let's wait and see what happens in the insurance sector. It's quite interesting to follow currently. Now I'm giving you a short overview of my current positions in stocks. As you can see, ENPH Energy, second from the bottom, is now my second smallest position because of the huge drop in the stock. But my second biggest loser in the portfolio is LVMH, which is only down about 10%. So not too shabby. And if Enphase is the only stock from 22 stocks in total that is dropping so much, and all the other stocks are making percentages returns, as you can see in the green in the P&L in percentages, then I would definitely sign up for that from the beginning. So I am very pleased with my portfolio, with the diversification, and I will continue to build it out, of course, and increase my position sizing. As I also mentioned that I do not want to surpass 25 stock positions. So if I'd like, I can add another three, but from then on I will have to be more selective in my stock picks, so that the quality remains, and I will be able to keep outperforming the market. If I diversify too much, then it will become way harder to outperform perform the market. Now I'll also show you my option contracts and the P&L changes in the past week, because I did not make any moves in option contracts and did not trade any options this week. That's it for today. Note that this is not financial advice. You can find the full disclaimer in the description. Please like, subscribe, and thank you for watching.